The Strait of Hormuz, a 100-mile stretch of water between Iran and Oman. 20% of the world's entire oil supply flows through it. And right now, it is effectively closed. Welcome. Today is April 14th, 2026, and Wall Street is staring into the eye of the most significant geopolitical oil shock in modern history. This is not a drill. This is the Iran war, and it is reshaping every single trade on the planet. Stay with us.
The gates of hell opened. How the Iran war started. To understand what is happening to your portfolio today, you need to understand how we got here. February 28th, 2026, in the pre-dawn hours of a Friday morning, the United States military and Israeli forces launched coordinated airstrikes across Iran. The targets: oil, refineries, nuclear facilities, military command centers, and within hours, everything changed. The Sharon oil refinery in northwestern Tehran was hit. Smoke rose over the Iranian capital in plumes visible from satellite. Oil depots were struck, leaving fuel tankers and vehicles unusable across a wide radius. But here is the moment that changed everything for markets, and for you as an investor. Iran responded by doing something it had threatened for decades but never fully executed. It effectively shut down the Strait of Hormuz. Let that sink in. Before this war, roughly 20% of all the world's oil and gas passed through that narrow waterway. Hundreds of ships per day, super tankers carrying millions of barrels of crude liquefied natural gas that heats homes in Japan, South Korea, and Europe. All of it stopped. In the days before the strikes, war risk insurance premiums for ships transiting the strait had already spiked from 0.125% to between 0.2 and 0.4% of ship value per transit. For a very large oil tanker, that translated into an extra $250,000 per crossing, just in insurance. By the time the shooting started, fewer than 10 ships per day were making it through a corridor that normally sees hundreds. On the morning of March 2nd, 2026, the Monday after the Friday strikes, Wall Street opened to chaos. Brent crude, the global oil benchmark, exploded higher. The Dow Jones Industrial Average shed nearly 600 points in the first hour. Gold surged, the dollar surged, and the tech-heavy Nasdaq, home of the Magnificent Seven, went into freefall. Here is the brutal arithmetic of what that moment meant. The world had just lost access to 20 million barrels of oil per day, almost overnight. There is no pipeline network on Earth large enough to replace that, no strategic reserve large enough to cover it for more than a few weeks. The United States, in coordination with the IEA, announced the largest emergency release of strategic petroleum reserves in history. 400 million barrels, just to buy time. Washington even temporarily lifted sanctions on some Russian and Venezuelan oil to inject more supply into the market. None of it was enough. Within days, the economic shockwaves were global. Pakistan told cricket fans to watch games from home to conserve fuel. Thailand reported shortages. Hundreds of gas stations across Australia ran dry. Airlines began canceling flights from Vietnam to New Zealand. The International Energy Agency would later write in its April oil market report that global oil demand was expected to contract by 80,000 barrels per day in 2026. A forecast revised down nearly 730,000 barrels from just 1 month earlier. The projected decline in the second quarter alone would be the sharpest demand destruction since COVID-19 in 2020. This was no ordinary oil shock. This was the largest supply disruption in the history of modern energy markets. And Wall Street was only beginning to price it in. 6 weeks into the conflict, the strait remains effectively closed. Brent crude has gone from approximately $64 a barrel before the war to over $125 at the peak. That is a gain of nearly 100%. WTI, the American benchmark, traded above $112 a barrel. Gas prices at the American pump, already up more than $1.20 per gallon since the war began, The national average hit 412 on April 13th and climbing. Ladies and gentlemen, this is chapter 1. The gate has opened, and everything that follows will define where the markets go for the rest of 2026.
Oil, gold, and the winners nobody expected. In every war, in every crisis, in every moment of maximum fear, there are losers and there are winners. Today, in Chapter 2, we're going to talk about the stocks that are winning right now on April 14th, 2026. Because while most of the market has been bleeding, a select group of companies has been printing money. Let us start where the action is. Oil. ExxonMobil ticker. Exxon, one of the oldest, most battle-tested energy companies on Earth. When oil prices spike, Exxon does not just benefit, it dominates. How dominant? As of March 31st, 2026, ExxonMobil shares had gained 41.95% year to date. That is nearly 42% in 3 months in a market where everything else was falling apart. This is not a coincidence. This is the iron law of economics. When supply collapses and demand remains, whoever produces the commodity wins. Every single dollar that oil rises above, Exxon's production cost drops almost directly to the bottom line. History backs this up. During the Russia-Ukraine war in 2022, Exxon returned 87.4% to investors, while the S&P 500 fell 19% in the 1970s oil embargo. Exxon replaced General Motors as the largest corporation in America by revenue. The pattern repeats every single time. Next, Chevron ticker, CVX. Chevron gained 37.09% year to date through the end of March. Analysts at Seeking Alpha estimated that Chevron would see approximately $1.7 billion in additional quarterly earnings due to elevated crude prices. Money that flows directly into accelerated stock buybacks and dividend support. CVX trades at roughly 18.7 times forward earnings with oil above $100. Analysts suggest a justified target of 20 times, meaning the stock has room to run even from current levels. And the energy sector broadly, the XL, the Energy Select Sector ETF, rose over 34% in the first quarter alone. For context, the S&P 500 as a whole was fighting to stay flat. Then there is ConocoPhillips, ticker COP, the pure play exploration company. No refining, no chemicals, just finding oil and pumping it. When crude spikes, COP captures even more of the upside than the integrated majors. In 2022, ConocoPhillips returned 71.7% in the current crisis, up significantly, and the momentum continues. Oil services companies like Schlumberger, ticker SLB, and Halliburton, ticker HAL, are also surging. When oil companies make more money, they spend more on drilling and services. The entire food chain benefits. Now, let us talk about gold. Because gold has done something extraordinary in this crisis. Gold has officially decoupled from the stock market and hit a staggering record. 5,300 per ounce year to date. The metal is up 24%. Why? Because gold is the ultimate safe haven asset when investors fear inflation. And oil at $125 per barrel is deeply inflationary. They buy gold. When they fear regional instability that could spread, they buy gold. When they fear that central banks will be forced to keep rates high, even as economies slow, they buy gold. Gold miners are tracking this move directly. Companies like Newmont Mining and Barrick Gold have seen their stock prices surge in lockstep with the metal's historic rise. For those who want broader exposure without picking individual miners, the GLD ETF, the gold ETF, has become one of the most purchased instruments on Wall Street during this crisis. And then
defense stocks. Lockheed Martin, ticker LNT RTX Corporation, Northrop Grumman L3 Technologies, the Global X Defense Tech ETF, ticker SHELL. When the United States goes to war, defense budgets expand, contracts accelerate. The pipeline of government spending into these companies surges, and with both the US and Israel engaged in active military operations, the aerospace and defense sector has become one of the most actively bought sectors on Wall Street. There is also a global dimension. NATO allies in Europe are dramatically increasing defense spending in the wake of this conflict, creating additional demand for American-made military hardware. One more winner that nobody saw coming: oil shipping companies. When the Strait of Hormuz closes, tankers cannot take the short route to the Persian Gulf. They must go the long way, around the southern tip of Africa, that doubles or triples the transit time. It dramatically increases what analysts call ton-mile demand, the total distance that oil must travel to reach its destination. Frontline Corporation, ticker FRO, and other major tanker operators have seen their revenue explode as a result. Longer routes mean more days at sea, higher charter rates, and dramatically higher profits. So let us recap the winners as of April 14th, 2026. ExxonMobil, up over 41% this year. Chevron, up over 34% this year. The energy sector ETF XLE, up over 34%. And Q1 gold, up 24% at record highs above 300 and counts. Defense stocks,